And the goal of this video today is to help you be crystal clear on what it takes exactly for you to qualify for a home purchase. These are the 3 financial qualifications that lenders will evaluate for you, which we call the big 3. If you'd like to buy a home in 2023 or beyond, these are the 3 big financial qualifications that you will need to focus on prior to your home purchase. So the 3 are your credit scores, your income, and your down payment. The lender is going to want to see that you have a solid payment history. Therefore, they're going to look at your credit score. Next, they're going to want to make sure that you have enough income to pay your monthly mortgage payment. Thus, they want to see your income. Lastly is your down payment. The lender is going to want to see that you have some stake in the game, either by providing a down payment or using a down payment assistance program. Before we jump into it, my name is Josh Spector with the Spector Group here in Denver, Colorado. My focus is to educate and assist first-time homebuyers throughout the home buying process. If you'd like to learn more about home buying, go ahead and subscribe to our page below. Now, if you're like most first-time homebuyers, you probably don't know exactly what it takes financially to purchase a home. And the goal of this video today is to help you be crystal clear on what it takes exactly for you to qualify for a home purchase. Now, you're probably online looking at homes on Zillow or Realtor.com or wherever you shop for homes, and you may even have a hard time evaluating that 6-figure price tag next to each home. Do you have to save up the amount of cash to buy that home, or can you finance that home? How does that work? Today, I want to show you how you can finance the home, because not many first-time homebuyers have the cash to buy a home outright. So let's focus on what exactly you need, or what qualifications you need to purchase a home. All right, the first one of the big 3 is going to be your credit score. I recommend this being the first one that you evaluate when you're going through your big 3, because if your credit score has not been established, for example, you haven't opened up a credit card, you don't have any loans, any student loans, anything of that nature, then you likely haven't even established a credit score, which is fine. Some first-time homebuyers have not established credit yet. On the other hand, maybe you have established credit, but it's not where you want it to be. The minimum threshold to qualify for a home is a credit score of 580. Now, 580 gets you into a home, but it doesn't get you into the best interest rate. So that's why I recommend evaluating your credit scores first, see where you're at, and then maybe take a month or 2 to fix it if there are fixes that can be made to your credit scores, or establish your credit entirely. You're probably familiar with Credit Karma or your credit card company. Maybe Chase sends you your credit score every month. I just want you to know that that's not exactly what lenders are going to look at when they evaluate your credit score. So what you need to do is go to a mortgage broker who's going to pull your credit for you. And the best thing about going to a mortgage broker is if your credit scores are not where you want them to be, they can likely give you a couple tips and tricks to get that score a little bit higher. Because the higher score that you have, the better interest rate that you receive on your loan. Next, part 2 of the big 3 is going to be your income. Now, I want you to put yourself in the shoes of the lender for this step. Is the lender going to want to lend somebody the money for a home that doesn't make enough to pay it back? So we're going to use a $5,000 example. If you make $5,000 a month, is the lender going to lend you the money for a home that's going to cost you $7,000 a month? No, it doesn't make any sense at all. The lender wants to evaluate your ATR, or your ability to repay. The rule of thumb here is to keep your total debt under 50% of what you make. So going back to that $5,000 example, your total debt, which includes your new mortgage payment, needs to be less than 50% of what you make. So $5,000 a month, you can qualify up to $2,500 a month in debt. So if you have a car loan for $500 a month and that's your only other debt, then you're only going to be allowed to borrow $2,000 a month for your mortgage payment in order to keep your debt ratio under 50%. There is some wiggle room here, and you also don't have to spend every penny of what the lender allows you to borrow. So if you can borrow $2,500 a month, then maybe you only feel comfortable borrowing $2,250 a month or $2,000 a month. That's totally fine. Also, other loan programs may allow you to borrow a little bit more, but again, it's whatever you're comfortable with and whatever you can qualify for. Now, if you don't make enough to qualify for the home that you want, say it's a condo and it costs you $2,600 a month, you are allowed to have a cosigner on your loan. I've seen this be grandparents, I've seen this be parents, and sometimes friends, if the friends align with the vision for the home. But let's just say you're using your parents. Your parents are going to have to qualify for the loan as well. The lender's going to look at their assets, their income, and their credit scores. So a lot of first-time homebuyers do utilize their parents when they're buying their first home, because the first one is a very difficult one to obtain. Lastly is the third and final part of the big three, and this one is very special and near and dear to my heart. This is your down payment. Now you may be thinking, why is a down payment near and dear to his heart? Well, it's because I love getting people into down payment assistance programs. But before I get into that, I just want to let you know, first things first, you do not need 20% down to purchase a home. Think about it really quickly. If you're buying a $500,000 home, you would need a $100,000 down payment. That is an old rule. It's an old myth. It's not applicable anymore. And luckily, you can purchase a home with anywhere from 3 to 5% down. Or you can use a down payment assistance program, which will allow you to put as little as $1,000 down here in Colorado. So as a first-time homebuyer, you could be eligible for one of these down payment assistance programs or grants. And the grants sometimes don't even require a repayment of that down payment. These programs are readily available for Colorado homebuyers and homebuyers all over the country. I work here in Colorado. If you need down payment assistance in another state, feel free to reach out and I'll get you connected with a mortgage broker who can help line up down payment assistance for you. Now, I just want to be transparent about these programs. There is a drawback of using them, and that's the fact that you will take on a higher interest rate than if you use your own down payment at closing. So if you can scratch and claw your way to a 3 or a 5% down payment, it may be worth it in order to keep your monthly payment, your monthly mortgage payment, a little bit lower by taking on a little bit lower interest rate. Also, family members are able to provide you a down payment in the form of a gift. This is another avenue that first-time homebuyers utilize in order to get into their first home. That's it today on the big three. Now, if you're a renter and you're thinking about maybe buying a home, check out our video at the top here about buying versus renting.